Okay, so it's recording. Right. Okay, so apologies for that bit of a technical issue, which was beyond my control. I couldn't really do anything. I don't know what happened. A bit about myself. I come with a wealth of 15 years of trading experience. During this time period, I have worked as a hedge fund trader for Bank of New York Mellon and as an equity trader with Bank of America, currently providing services as a chief analyst for AvaTrade. And welcome to our weekly webinar. Bit of a disclaimer and risk warnings in front of you. If you have any further questions, feel free to come back to us. Here are the contact details for our social channels such as YouTube and Twitter. Something that we need to discuss very briefly is about AvaTrade's unique technology, AvaProtect. It's a revolutionary one-click risk management tool available on the AvaTrade web trader and AvaTrade Go app. With AvaProtect, you can purchase protection against loss for a defined period after opening a position. If the protection ends and you have an open position that is losing, AvaTrade will reimburse the loss directly into the trading accounts. The only cost is the AvaProtect fee itself. I recommend you guys to speak to your account managers. This is a very cool, unique feature that AvaTrade has in its wallet. Right, now, let's go back to our generic questions. Now, some of the questions, some of the people like Amutha, Andres, and Kevin, I know that you guys have attended some of these ones, and I'm hoping that you guys will help us to everyone to understand some of these questions. So here are our study questions. Number one is why do you want to trade indices, the inverse of indices, the fund flow, defining levels, and defining strategies. Over here and over here, we will be talking about the market's price action, primarily what is happening in the market right now and where are the opportunities. Over here, we would be discussing why someone wants to trade indices, what are the benefits or what are the cons for that as well. So Amutha, I'm going to bring you into the spotlight. And why don't you tell us, help us with this study question, why one wants to trade indices? What are the benefits, pros, for this one to trade indices? And while Amutha may be writing, Kevin and Andres or anyone else within this room can help us to understand this particular question. What is your opinion? Why one wants to trade indices? And there you go. Amutha has defined that quite nicely. So Amutha is saying that this is a group of stocks and is a less risk, and it helps you to diversify. So those are the major components of the indices. Number one is you have a more probability of taking more profits on a day trading basis, like for day traders. This is a really good thing because the moves are pretty big. For hedging, of course, this gives you a very wide hedge and exposure across the various different asset classes. And of course, this is a group of stocks which is combined in one basket. So an index such as the S&P 500 index represents the top 500 companies over in America. Similarly, the Dow Jones represents the top 30 industrial stocks in America. So, and for the UK, it is the UK 100, also known as the FTSE 100, represents the top 100 companies in the UK, top 30 industrial companies in America, top 500 companies in America. So if you don't have too much money to put in all the 500 companies, what you can do is you can just buy an index. And when you buy an index, you get an exposure for everything within that. The same goes over here by buying the 30 Dow Jones Industrial stocks. you get also you are hedged, because if one stock goes up or if one stock got 3 stocks goes down, you are kind of hedged because there is something which is pulling the index to the upside. So your portfolio is not dropping rapidly in comparison to if you have one single stock. So for example, if you have GE or if you have Apple only in your basket or in your portfolio, and all of a sudden Apple comes up with a very bad earning, you're going to get very, very sharp drawdown on your portfolio. Your portfolio equity is going to look like something like this. Now, if you have on the other side Tech 100, which is basically your NASDAQ, it contains a lot of other stocks. So your equity line, your portfolio line isn't going to be looking like this. It may just go very slow, and then it may still actually start sort of move towards the upside. So in comparison to the Apple, if the earnings are down, you are absolutely going to see your equity falling like that, because you have an exposure to one particular stock. So that is the hedging sort of a mentality behind that. So when you buy an index, you buy 30 stocks altogether in terms of the Dow Jones, and in terms of the S&P 500, you buy the 500 stocks, which includes your Tesla. So you don't have to buy Tesla alone. Just like how Tesla dropped 12% yesterday, PayPal dropped over 10% yesterday. So imagine if you had those two stocks in your account, you would have been down yesterday by over 22%, which is a massive drop for a portfolio. So, but if you had S&P 500 in your account, or as an index, if you were trading Dow Jones Industrial, you would have only been down by less than 1%, because both of these ones, they were down in around that particular mark, or even actually slightly bit less than that. So that kind of gives you the overall answer that why do we want to trade indices. Now, the next study question is again the inverse of indices. So Kevin has mentioned something really interesting as well. There are plenty of stocks to trade and more opportunities. Exactly, Kevin. Now, what is the inverse of indices? Something that we have discussed before, which is called the VIX. This is your volatility index, and this is your S&P 500 index on this side. So S&P 500 index represents your top 500 companies, as I mentioned earlier. So when S&P 500 index moves to the upside, the VIX over here moves to the downside, because this is the inverse index. So this tells us when the risk is up, when there is a more risk in the market, people are concerned, then what happened is the volatility index goes up. So this particular section over here, it goes up. And what happened over here, let me just draw the line in here. What happens over here, then the S&P 500 index goes down. When risk levels are less, meaning people are feeling less risky into the market, the VIX index over here goes down, which is right over here. So it goes down, but the S&P 500 index on the other side, it moves to the upside. So it has the opposite relation among each other. So when one moves up, so when here is VIX, here is your S&P 500. When this goes up, this goes down, and when this goes down, this goes up. So that is some sort of a relationship that they have between them. And when this one is at an all-time low, or it is, make at an ultra low levels, that kind of gives us an indication at that time that there is a risk for the S&P 500 index, meaning if you are long on the S&P 500 index, time to take profit and or maybe get out of a market altogether. So that is the sort of a relationship between that. And the opposite over here true as well. So when this one is way too high, at all-time high or near all-time highs, then this is probably at the time is going to be sitting at a very, very low levels, ultra low levels it will be sitting at, that means that you don't need to be afraid of the market because the market is very, very oversold. So it is time to buy at that time, because follow on, we are likely to see a massive rally into the markets. Are you clear about these two questions? Any questions in around these two study questions? Okay, great. And of course, we will see the live examples of these ones into the market as well. Now, fund flow is basically a determination whether the money is going into the consumer sector, whether it is going into the technology sector, whether it is going into the material sector, whether it is going into the energy sector, whether it is going into the industrial sector, whether it is going to the consumer discretionary sector. So many different sectors. You have altogether 11 sectors of the S&P 500 index. So we see by looking at it where the market is really moving. Usually what we will do is we will look at S&P 500 index, okay? And then we will compare that with the Tech 100 index, which is your NASDAQ. So we compare that how the overall market is doing, and then of course we also look at Dow Jones 30 at the same time. So Dow Jones 30 represents a very small portion of the market. We mainly pay attention to the S&P, and we mainly pay attention to the tech index. So we see that where the markets are really going and what they are doing. So can I trade inverse indices in AvaTrade? Yes, Mohammed, you can certainly. We have an index which is called, the ticker is VXXB, which is your volatility index, which is your VIX index in other words. So I hope that answers your question. Now, it's time for us to go on to our charts and then really define from that perspective that what exactly is going on into the market. Now, something which is quite important, I know this is mainly about indices, but I wanted to point out this particular opportunity for you guys, is that in about less than 14 minutes, we're going to get the CPI data. When that data is going to be out, I won't be with you guys, because I will be potentially trading that trade. What I will be looking at, this is your inflation data. In 14 minutes, it is going to come out. If this data comes in slightly lower, then we're going to see a big moves into the market. If this data comes in higher than the expectations is something that we've got to be measuring this data against everything, okay? If it comes higher than the expectations, then that means we are going to see a massive moves into the market as well. So both of them are quite important in terms of the data point. So very, very important. Now something quite interesting over here. This is your gold chart. So this is where the actual the resistance was formed over here. Then after this price stopped over here, it went back up again over here, but then it dropped sharply. It came into this area of support. We saw a massive rally, came into this area of resistance. So this is the third time the price was coming, failed to break it above, and then it moved back to the downside. Now it is, for the fourth time, it is back into this area of resistance. Now at 130, we are going to see massive moves over here. Now, there are two possibilities of that. Number one is you could place your stop loss just above that 1835 and short this market, and then look for the move towards this particular area of 1719, 99 to 1792. This is where your 200 day simple moving average is trading. This is your 200, this is your 100, this is your 50 day. So 50 days trading over here, they're all simple moving average. So at 130 precisely, if it starts to break, if you see the first move to the downside or something like that, you could trade it and then buy it over here, or further buying could happen in around this particular area of 1751. Otherwise, if the price begins to move to the upside and it breaks out of this particular zone, what you may want to do is put your stop loss just right over here at 1810, and then the next target in terms of this particular price action is really going to be in around this particular area, really. That 1863 area is going to be the most important one for this one to go over here. So in terms of a risk to reward, it would be your risk. And in terms of a reward, your entry is kind of getting into here, is going to be here. So it's not really that great risk to reward ratio, but for a day trader, you still have a 1.5, meaning at least on that perspective, you can still take that particular trade. So keep an eye on that. Make note of these particular price levels. So this is your resistance, this is your support, that is your another sort of a support. I'm just going to define the other support a little bit more clear because it has moved a little bit ever since. So what I want to do is I wanted to move this support level to here. And because it is a support level, we will change the color to green, because our support levels are always in green, and resistance on the other side is in red. So support level number 1, support level number 2. In terms of a resistance, the next resistance that we are focused on is at 1877 to sort of over here 1864. So again, these are your resistance. So we will change the color to red to keep things in line with everything else. So this, again, in 12 minutes, in now less than 9 minutes time, you're going to see that particular move. Now, what else you're going to see in the 9 minutes time is, of course, a massive move over here. This is your Dow Jones 30. It is trading well above the 200, 50, and 100 simple moving average. It is well due a correction which is going to bring the price closer towards these particular price levels over here. So the short trade is going to be putting a short on the top of this one, and then really look for the trade to come over here, or at least come into this area as an aggressive area to buy, or 35425. This would be your support area over here. This is your stop loss area over here, just above the top of this candle. However, if it flips its direction and it breaks above this particular price action and then it moves to the upside, then what you may want it to do is perhaps wait, because I don't want it to buy this one, because the RSI is really telling us that we are overbought already. So we will wait. Whatever the new all-time high would be, we'll place a stop loss on top of that, and then we will use the same strategy and then let's see for a move, for this particular move to back to us over here. That is what we want to see in terms of the price action. So equity market overall is way overbought, and it is well due a good decent correction. The same goes over here with respect to the US 500 index, US Tech 100 index. This is your NASDAQ. Your stop loss on the top of this one. Again, the buy area is going to be just right over here in between this one, just below that 15,393. So between 15,250 to 15,390, this is your buy area. So you will let this trade to come over here, perhaps, or at least into this area over here, which is about 15,800 at least over here as an aggressive level. And on the buy side, we will not be taking that because, again, the RSI is way overbought. I know it's not showing over here, but you just have to take my words on that, which is the S&P 500. The Tech 100 is absolutely overbought. Now, the third one is your S&P 500 index, the Dow Jones Industrial Average. For the Dow Jones Industrial Average, we are looking at the same situation over here as well. I'm not sure if we did that Dow Jones. Sorry, give me 1 second. Did we do the Dow Jones? Okay. So, sorry, the S&P 500 index, that is what we're going to do. So with Andreas, I will answer your question just in a bit. Stay with me. Okay, over here with the S&P 500 index, this is slightly bit more positive. Why? Because look at the chart for the US Tech 100 index. The Dow Jones Industrial Index. Dow Jones over here, we are about to become bullish because the 50 is going to cross above the 100. But with respect to the US 500, that is already trading above that. Doesn't matter. We're still not looking to buy right now. I think it is quite difficult to buy at such an expensive level. RSI is already telling us the stop loss is going to be on the highs of these ones, 4,750. The immediate sort of a support level is going to be at 4,777. However, we could potentially see the price coming into this area of consolidation. So I'd like you to keep a focus on that. Otherwise, it is this area of consolidation as a second support level. So support level number 1, support level number 2, or support level number 3. We can also call this one take profit number 1, take profit number 2, take profit number 3. Now, of course, the price can always reverse its direction. It is very possible that we may not get any of these ones, and then what the price ends up doing on the back of the data, if the inflation comes lower, we see this data, this particular S&P 500 moving to the upside. Under those circumstances, we still kind of wait. We don't really put that trade. Right. Now I'm going to get ready for the CPI number because we also have the TV interviews like the last time. So I'm going to make a little bit, few minutes short. Just going to answer Andrea's question very, very quickly. Yes, there is a relationship between S&P 500 and gold. When S&P 500 moves up, gold moves down. When gold moves down, S&P 500 moves to the upside. However, that relationship isn't the strongest currently at the moment, meaning S&P and gold can move in the same direction as well. All right, guys, thank you so much for joining as always, and I'll see you guys on the other side.